Hello, I'm Shivam, a fourth-year student at BITS Pilani Hyderabad campus. I'm presenting a stock pitch report on Tata Motors as part of the Equity Research Initiative program at BITS. There are three parts to this. First, the fundamental analysis, followed by the ratio analysis, and finally, the valuation of Tata Motors. Tata Motors is a subsidiary of the Tata Group and is headquartered at Mumbai in Maharashtra, India. It is one of the world's largest automobile manufacturing companies. It is currently being traded on the Bombay Stock Exchange, the National Stock Exchange of India, and the New York Stock Exchange. Macroeconomic conditions. India's GDP has been very high over the last 7 to 8 years. It has tapered down a bit but is expected to pick up again in the next year or so. According to the Society of Indian Automobile Manufacturers, there has been a 15% increase in car sales in August 2013 compared to last year. The passenger car penetration in India is one of the lowest internationally. Growth in the population categories with higher incomes. The young population in India is one of the highest in the world and is still increasing. The government also gives a lot of incentives to manufacturing companies. All these are favorable conditions for Tata Motors. The Porter's 5 forces model and SWOT analysis were also applied for Tata Motors with favorable results. Now the financial ratios. The liquidity position, as illustrated by the current ratios, of Tata Motors is very stable because the ratio has been close to 1 over the past few years and has also been very stable. The leverage ratios, like the debt to equity, have decreased over the last 5 years. This says that the Tata Motors is manufacturing their finances better. The stock valuation multiples like the P by E and EV by EBITDA have also been increasing over the last 5 years. All these indicate that Tata Motors has been performing well in the industry. Now coming to the valuation of Tata Motors. The dividend discount model is not applicable in this case because the dividends are not uniform and cannot be forecasted accurately. Because of this, the valuation was done using the FCFE model. Now the values for RF, RM and beta which were used are displayed on the screen. The value per share was found out to be Rs 383.51. The risk-free rate of return used is the rate of return on Government of India bonds. The market rate of return is derived from the Sensex, and the beta from the Bombay Stock Exchange website. In summary, the fundamental analysis showed that the macroeconomic conditions in India are very favorable and the sales are likely to increase in the future. The ratio analysis indicated that the company is financially stable and all its ratios are in line with the industry, if not better. The valuation showed that the value of the stock was Rs 383.51 at the current market price of 342. I recommend a buy on the stock. Thank you.